Pamela, let us quickly go through the cash flow statement. I already have videos on the cash flow statement. I just want to revisit it and probably re-explain it differently. Please do note, however, that there are videos on this. It's lesson 1 up to lesson 15. I'm not going to go through the introduction and stuff. I'm just going to go straight into it. The first thing that I'm going to start with is us calculating the cash generated from operations. So the cash generated from operations has two parts. Now, the first part is where we take our profit before tax, we adjust it for depreciation, and we adjust it for interest expense. Right. So we adjusted for depreciation as well as interest expense. Depreciation is a non-cash item, and already it has been deducted from profit before taxation. Because it's a non-cash item, we are going to add it back. And that is solely because when we prepare the cash flow statement, we only are concerned about cash. We don't care about any other thing except for cash. It's all about cash movements. Is it a cash inflow? Is it a cash outflow? And depreciation has already been deducted from profit before taxation. However, that when we deduct it from profit before taxation, we are saying that it is reducing our cash, and that is not true. And that is why we have to add it back. And the reason why we add back interest expense, even though it has been deducted from profit before taxation, it is because interest expense will be shown separately on the face of the cash flow statement. I hope you got that. All right. And from these profit before taxation, you can also adjust it. And this is for those that are writing, what do they call it? Cambridge levels and stuff. They normally include such things where you need to basically subtract non-cash income, all right? And you will have to subtract interest income because it'll also be shown separately. For IEB, they haven't really asked this. I think they have, but they didn't actually put it as a question where they gave students profit from the sale of an asset. Okay, profit from the sale of an asset. Please note that it doesn't affect the cash part in the statement of profit or loss. Okay, so that's why in that scenario they had to subtract it. It will be the selling price of the asset that was sold. We are going to show it as a as proceeds from the sale of an asset, of which it will include profit in it. So that profit will be shown, that cash part of your profit on sale of an asset will be shown under investment or investing activities. To prepare this note or the first part, we basically just need information from the statement of profit or loss. That's it. Okay, we need information from the statement of profit or loss. This is only to prepare the first part. However, things like depreciation might not be there in the statement of profit or loss. So you will need tangible assets information. They'll normally will give you carrying value at the beginning of the year in the statement of profit, in the statement of financial position, and give you carrying value at the end of the year in the statement of financial position. And they will give you additional information to tell you if there was any asset sold, if there was any asset purchased, and then you will have to manipulate it to calculate your depreciation. Or they will give you a depreciation rate. So basically, to prepare this first part, you will need the statement of profit or loss, and you might also need your tangible assets note as well as the non-current liabilities note for interest. So for when you want to calculate interest, but they will give you more information. And ideally, just to prepare the first part, the most important note will be your statement of profit or loss, i.e. the income statement. Now, these two items have already been added. The reason why we're subtracting them is because for the profit on sale of an asset, I said it will be shown under investing activities. That's why we have to subtract it. But with your interest income, you'll normally show it in the face of your cash flow statement. We won't do it this year. We won't do it this year. You will actually do it when you get to varsity. I'm definitely sure about that, okay? So you need to also take into account any non-cash income. So any income you have earned that is non-cash, you need to subtract it from profit before tax because it does not affect the cash inflow of the business. That's why we have to subtract it. And that is solely because it was already added. So that's why we have to subtract it. So the net effect will be zero with respect to that specific item that we are adding, we are subtracting, okay? Now, the second part, which is working capital, changes in working capital. I want to start, actually, it shows me the everything. I want you to understand what goes under working capital, okay? The first thing that goes under working capital is inventories. The second one will be trade and other receivables. And the third one will be trade and other payables. I hope you heard that. Changes in working capital. You focus on only those three people. Trade and other. Let me start with the first one, which is inventories. And then you will have trade and other receivables. And the last one will be trade and other payables. Only those three, nothing else except for those three. And then you are going to look at the movement of those three items. I will start with inventories. You will ask yourself, is inventory going up or is it going down? An increase in inventories is a cash outflow. And the reason why it is a cash outflow is because you basically have more trading stock. And for you to have more trading stock, you must have bought that trading stock. And that's why when you buy, how does that affect your cash? It will result in your cash going out. So an increase in inventories is a cash outflow. Now, normally for some students that just don't want to know anything as to the whys, I normally tell them that increases outflow, decreases inflow, because they don't want to know why. Okay. But if you are interested in knowing the why, the decrease is associated with you selling the stock. So when you sell the stock, you will make money, and that results in a cash inflow. So a decrease in your trading stock means you sold that stock, and that will be a cash inflow. It will result in a cash inflow. And that is for inventories. When it comes to trade and other receivables, note, you need to understand what it is. Trade and other receivables is what is owed to the business, to us as the business. And if we are owed more, it simply means that we gave people stock and we are losing out because that stock that we gave people for free, we gave it to them for free, not really for free because they'll pay us later, but I just want you to understand that you gave it to them, but you're not getting anything back immediately. Okay. And that's what trade and other receivables is. So you gave people cash. It can be I don't want to include SARS because we normally exclude SARS income tax. We normally exclude the others that we exclude will be under trade and other payables. I don't want to exclude it, but sometimes we give people our money, okay? And that's why they're owing us. So when we give them our money and they owe us, it means that we lost money, okay? We lost money. Trade and other receivables, when they go up, it means we are losing money. That stock that you gave to a person on credit, you could have sold it to someone else for cash, so you lost money. So you took your money to buy that stock. So you lost it and you gave it to somebody else. You lost money. Increase in trade and other receivables is associated with cash outflow. A decrease in trade and other receivables is associated with cash inflow. It means that people that are owing you are paying you back. That's why they're owing you less. Okay, they owe you less because they're paying you back. And when they pay you back, that is a cash inflow. A decrease in trade and other receivables is a cash inflow. The last one will be trade and other payables. When it comes to trade and other payables, remember to exclude three things. The first one will be accrued expense. You exclude accrued expense only if it relates to interest on loan, only if it relates to interest expense. That's the only time you exclude accrued expense. Otherwise, you don't exclude it. Second one will be SARS income tax. You only exclude SARS income tax. You do not exclude SARS VAT. You do not exclude SARS UIF. You only exclude SARS income tax. And that is because SARS income tax is so material to the readers of your cash flow statement to the extent that it needs to be shown separately because it will result in the readers making wise financial decisions. That's why we have to show it separately. Only SARS income tax. Now, when SARS income tax is in trade and other payables, it means that we owe SARS that income tax. So our provisional payments were not enough to cover for our income tax expense. I made a video on that under adjustment. Okay, check that out. It relates to income tax. Please check that out. The third one that we have to exclude is shareholders for dividends. Shareholders for dividends will also be shown separately in the face of your cash flow statements. That's why we have to exclude them. So we exclude SARS because it must be shown separately on the face of the cash flow statement. We also have to exclude interest on loan because it will be shown separately on the face of your cash flow statement. And the last one was did I say income tax? Is interest on loan accrued expense, it's income tax, and it is dividends. Those will be shown separately. And the reason why we exclude those and we show them separately is because those are extra costs that we pay for, but they actually do not, even though we include them under operating activities, they are not a result of operating activities. They're expenses we incurred because of our financing. Shareholders finance us, so that's why we pay them dividends. What else do I have? Lenders finance us. That's why we pay them interest. So that must be shown separately. The third party, obviously, this one we have to show. It's not really a financing activity. It's about SARS. The third party is SARS. We have to show that separately. And that is to also tell the stakeholders, anyone that is reading financial statement, that we are on par. We are paying SARS. We are not in trouble with SARS. So we are paying SARS. And that's it. That's why we have to show them separately in the face of your cash flow statement. I repeat, an increase. Well, I'm not repeating. This is what you need to note. An increase in trade and other payables after excluding those three that I mentioned. Please don't exclude accrued expense unless it relates to interest on loan or interest expense. I hope you understand that. Okay. An increase in trade and other payables, we will show it without brackets. And that is because trade and other payables, these are the people that we owe. So I might be owing this person because they gave us money. Like for instance, income received in advance. We received money. So an increase in trade and other payables is an inflow. But this person that gave us money, we need to pay them back in the future. I hope you understand that. But for now, it's an inflow. And another one will be creditors control. So when we buy stock on credit, please note that we are saving money because we can use the money that we had to buy other things. Because when we buy stock on credit, we're not paying the creditor now. We're going to pay them later on. So an increase in credit in what we owe, it results in a cash inflow. It saves us money, or it is the actual cash that we are getting from an outside party. A decrease in trade and other payables, though, is a cash outflow, as it means that we are paying that party back. Whoever we are owing, we are paying them back. You need to understand trade and other payables, it relates to the people that we owe. Anyone that we owe will be under trade and other payables, right? And that's what you need to understand about trade and other payables. And your net working capital is simply your current asset minus your current liability. And for us to prepare the second part, please note you will need either your notes to the financial statement, or you will need the statement of financial position. And that is to prepare the second part of your cash generated from operation. That is cash generated from operation, and it's changes in working capital and cash generated from operations. Note, so you will need the first part, you'll also need the second part, and I already told you where you will find that information. Let us look at simple examples where we are simply calculating our net working capital before changes in, it's basically an adjustment of our profit before changes in working capital. And this is the first part of this note. How do we calculate our operating profit before changes in working capital? You will start with profit. Guys, do not confuse this note to retained income. In retained income, we use profit after tax. Here, guys, we don't use profit after tax. We use profit before tax, okay? Unlike retained income note, here we use profit before tax. There are different ways of calculating profit before tax. You will come across that as we go. I will start with my profit before tax, which will be 60,000. And I will adjust it and add back depreciation for the current year, interest expense for the current year as well. And that will give me my operating profit before changes in working capital. Where I took the 60,000, I added it with 24,000, and you add it with 6,000, and that will give you 90,000 rand. Okay. What are we going to do here? You add profit before taxation. You'll start with profit before taxation, and then you add your depreciation of 90,000 as well as interest expense of 32,000, and that will give you your net change. Well, that is basically operating profit before changes in working capital. Easy, right? Let's move to the next one. I think you should give yourself 5 minutes to do these ones. I will start with my profit before tax of 900,000, added with depreciation, added with interest expense, and that will give me operating profit before changes in working capital, which will be 900,000 plus 188,000 plus 122,000. It will give me my operating profit before changes in working capital, which will be 1,210,000. Got it. Okay, let's do a combined activity. I do not have enough information here to prepare the first part. Let me just continue and see if I will get anything in the next slide. And no, I'm getting nothing in the next slide. So I'll go straight to my answer book and check what I have in my answer book. Oh, they have already prepared the first part for me. So I will just focus on the second part, which is changes in working capital. I don't know what happened there. And I will start under changes in working capital. I will start with my inventory, and my inventory, they have to give me inventories for last year and inventories for this year. And then I'll have to compare let's see if they gave it to me. And when I look at this, they did. My inventory for last year was 121,000. My inventory for this year is 105,000. There's a reduction in inventories. And a reduction in inventories, as I've said, is a cash inflow. It will result in a cash inflow. And I will show it as decrease in inventory. And a decrease in inventory here will be the difference between the two. It doesn't matter what you start with, guys. The most important thing is you indicating whether it is an increase or a decrease, because that tells you whether it's a cash inflow or cash outflow. A decrease is a cash inflow. A decrease in inventories is a cash inflow. An increase in inventories is a cash outflow. If you want to memorize it that way, that's good as long as you get it right, okay? But I prefer to tell you why that is the case. And you'll have to rewind this video because I told you why, okay? A decrease basically says that we sold stock, and when you sell stock, it will result in a cash inflow. Let's look at our trade and other receivables. Another way of doing that, guys, you can basically do a simple ledger account. You start with opening balance. Your balance carried down will be the closing balance of your inventory. On the, if your balancing figure, you just look for the balancing figure. Obviously here, your total will be where you have the biggest amount, which is the debit side. So that 121 is the bigger one. So I will total both sides and make sure that they give me 121. And you will notice that the credit side has a shortage. And if the credit side has a shortage, that shortage, we call it an inflow. If the debit side has a shortage, that shortage, we call it an outflow. So an inflow here will just be the 16,000 I just showed you. If it was on the debit side, if the shortage was on the debit side, it was going to be an outflow. But here, the shortage was on the credit side, which is an inflow, okay? A reduction of your asset, which is your inventory, will result in an inflow. Similarly, this side, in trade and other receivables, it is an asset account. You will start with your opening balance, excluding sales income tax, and closing balance, excluding sales income tax. If the balancing figure, let's see, the balancing figure here is still on the credit side. If the balancing figure is on the credit side, it is an inflow. If it is on the debit side, it is an outflow. Okay, this is when you don't want to think, you just want to make sure you get this one right. Let's move to trade and other payables. For trade and other payables, okay, let me just revisit trade and other receivables. So obviously here you will notice that it's a decrease, and a decrease in trade and other receivables will be an inflow. It results in a cash inflow, okay? And what about payables? An increase in trade and other payables, excluding, you exclude shareholders for dividends, you also exclude SARS income tax, okay? You only exclude accrued expense if and only if it relates to interest on loan. You only exclude accrued expense if and only if it relates to interest on loan. If they don't tell you, do not exclude it. They must tell you that that accrued expense includes interest on loan. If they say it includes interest on loan, let's say they said it includes interest on loan for 2022, it is 400, and for 2021, it is 500. Then you're going to take that 1,400 minus 400, take the 12,500 minus 500. Okay, if they said it includes interest on loan of that much. But sometimes they'll just put it in brackets that accrued expense, interest on loan, or interest expense. Then you exclude the entire amount. That 1,400 and that 12,500, you will exclude them when you calculate your totals. To exclude means you subtract them, or you don't include them when you find the totals. That's what it means, okay? And here they said nothing, so I'm not going to exclude them. And if I exclude only shareholders for dividends and SARS income tax, I will get these totals. And these totals, notice that your trade and other payables is going down. When it goes down, that results in a cash outflow. Or you can prepare the ledger account for trade and other payables. Please note that it will be a minus plus because it's a liability. The balance for this one will be on the credit side, okay? If the balancing figure is on the debit side, then it's an outflow. If the balancing figure is on the credit side, then it will be an inflow. In this case, when you prepare this, please note that the outflow will be on the debit side and a reduction in your trade and other payables. That's what it means. It'll be an outflow. And the difference, if the difference is on the debit side, or on the credit side, sorry, it will be an inflow. If the difference is on the debit side, it will be an outflow. In this example, it will simply be an outflow. And please check out the next video as we finish this off. And this is how we'll find our changes in working capital. So that 90,000 plus 27,200 will give you a cash generated from operations. You are going to put this as cash generated from operations under operating activities in the statement of cash flow. In our next video, we will be going through this. We have done it before. So you can check out the video on that. And if you still don't understand, I will basically re-explain it, okay? Kgotsong.